No, I mean, obviously, we for the longest time have been rightly so criticized for overspending. And we confirm our guidance for CapEx and R&D with a range, each of them 6.5 to 7%. I think we rightly prepared the market for an uplift this year in order exactly to be ready for what you are describing. This is CO2 compliance by 2020, but also for the continued electrification and digitalization of our offering, which is critical to meet those targets.
Frank, I just want to broaden out my question and just ask you about the cycle. And there's increasingly a sense of nervousness, I think, around the large-scale auto producers that we've actually had the best of this credit cycle. And I note that you talk about a slightly lower ROI compared to earlier year-ago levels. Could you comment on that? Where do you think we are in the cycle for your business? And is there the prospect actually that we're going to see trends weaken from here into next year?
I think we prepared the industry at our Capital Markets Day back in March 2017 that there is a very challenging transition ahead of the entire industry and us certainly as well, which means that there are even more ambitious CO2 fleet targets we have to meet, and this is only to be achieved if you electrify your fleet to a certain extent. And this balancing act of significant investments and expenditures in order to meet from a technical perspective this challenge, together with markets who are obviously, some of them actually have peaked, like in the United States, that this transition wouldn't be easy, but we believe that we have a very clear game plan and we are executing. And I'm very pleased that we can keep our guidance for the full year in terms of our operating margin with 6.5 to 7.5%. But I think it's abundantly clear that it is not easy, and I certainly understand that there are a lot of question marks, which you also see being reflected in the price-earning ratio for the entire industry.
And Frank, can I ask you, I mean, the news flow overnight is now that Donald Trump potentially is looking at 25% tariffs on Chinese products here. The Chinese have moved to try and defend revenue in their own auto industry, it seems to me, by cutting taxes. But the inevitable conclusion, I suspect, if we go full-blown trade war here, is that costs are going up for everybody, and we haven't even managed to resolve the US-Europe trade picture at this point. Could you comment on this? I mean, what kind of lunacy do you think this is as you look at it from Germany?
I think it's very obvious that for our industry in particular, stable framework conditions are really fundamental. And therefore, the nervousness in the market is partly a reflection on the discussion. Some people call it a war on trade terms between the United States and Europe and China. I think it's important that we come back to the negotiation table, that we find mutually acceptable solutions. But it is a difficult situation, and all those rumors and speculations are certainly making it very hard on investors to stay focused in our industry. But I think we still believe that all parties are very clear about the consequences of rising tariffs. And therefore, it is important that we come to equitable and fair solutions for all parties concerned. But it's a complicated subject matter.
Can I take a look at the story from the different side, from the Chinese side, where there's been some extraordinary measures in the last couple of weeks from the Chinese to try and stimulate and support the economy. And one of the measures that was flagged up was whether there could be a cut in the tax on passenger vehicles, which was certainly positive for your share price. How do you see that playing out? Do you think Volkswagen can ride a wave of lower taxes, whether that stimulates demand in the Chinese market?
I mean, history has proven in China that the reduction in sales tax is supporting the market. For the first 9 months, we have been able to grow at 5%, which is 4% higher than the overall market did. So particularly the last 2-3 months have been difficult with even a double-digit reduction in retail sales. So we are still all benefiting from the first 6 months, which were quite strong. Now, obviously, that is a possibility. I don't think that any concrete measures are being announced, but certainly we would welcome such a measure. And from a production and inventory perspective, we are well prepared for the opportunities who might come along for the rest of the year and possibly thereafter, depending on the Chinese decisions.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.